Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Welcome to the Purpose-Based Retirement. This is your host, Casey Weade, and I'm also joined here by my good friend and co-host, Marshal Johnson, Certified Financial Planner and Vice President at Howard Bailey Financial. We've got a fantastic show planned for you today. If you're at retirement, in retirement, near retirement, or you just want to retire someday, you found yourself a home. We promise that you're going to leave with great value today that can go back and you can implement these things in your financial life, regardless of whether we ever see you again in our offices. We promise this will have an impact on your life. So take out your pad of paper and take down some notes. We're going to kick off today's show discussing an article that I found quite disgusting and actually made me a little queasy. And then we're going to get to our second segment where we're going to ask questions from people just like you. We've got questions coming in from Chuck in Fort Wayne, Jerry in Angola. We've got questions about health savings accounts and retirements. And if we don't want to use annuities, can we use bonds? And what are our conservative, safe alternatives? And why are people asking those questions? We're going to answer that in our third segment as we discuss something called irrational exuberance. Is the market expensive today? And if so, what kind of returns can you expect moving forward for your retirement? Now, Marshall, to kick things off, we're going to be discussing an article titled 11 Great Reasons to Carry a Big, Long Mortgage.
Wow, that's quite a title. And you know, Casey, I think it's trying to grab some attention. I mean, anytime you say 11 great reasons, it's really going to be hard to back that up.
I'd love to see Dave Ramsey go toe-to-toe with this brokerage office because this was a broker that put this article out. And that was really, we're going to go through these different reasons and we're going to talk about the pros and cons of each one of these great reasons to own a mortgage. However, and not just own a mortgage, but a big and long mortgage at that. We want to go through these. And it's not all about, hey, each one of these things are necessarily wrong. It's the problem that we see when people many times will come in our office and we've seen people that have taken mortgages out on their home. I had a gentleman I worked with that I asked him today. We just finally got to his risk questionnaire. We were talking about how much he wanted to be. If he wanted to be more conservative, moderate, aggressive, he said, I want to tell you a story. And he told me a story about taking out a mortgage on his primary residence in 2007 and losing nearly the entire sum that he then took risk with. And he said, I'm just going to double my money real quick. And it didn't work out in his favor. That's why we want to discuss this. That's why we're discussing this article, is to say exercise caution, because people aren't always out for your best interest.
Well, and what's the motivation of the author? Well, the motivation of the author is he manages money for a living. Well, if somebody's going to take on a big, hairy mortgage like he discussed, well, then that's more money for him to go put into the market. So you just gotta watch out for this sort of stuff. Yeah. And this is the smoke and mirrors that we're always trying to illuminate for the folks out there. And you talked a little bit about, we're going to get into some of the tax features, because I think a lot of people say, well, you know, the mortgage can be a good thing, especially with interest rates this low.
Well, let's go to that.
Jump in.
So that was reason number 8 and 9. So reason number 8 and 9 was titled, Mortgages Allow You to Invest More Money and to Invest It More Quickly. Mortgages allow you to create more wealth than you otherwise would. Now, if we take that to the tax discussion, reason 4 and 5 said your mortgage interest is tax deductible and mortgage interest is tax favorable. So let's talk about the tax aspects, because that is typically why people will say, well, I'm not going to pay off my mortgage because I get some really good deductions from that mortgage interest, that mortgage interest deduction.
Yeah, well, you got to watch out for that, especially with the tax bracket that somebody's in. Now, we could make the case for somebody that's in the 38 or the 33 plus tax bracket. But as we were talking before we came on the air today, somebody that's in a 15% tax bracket, that's not a whole lot of savings. That's not a reason to take on a big, hairy mortgage.
Right, and it comes down to your effective tax rate. For instance, you could be in the 39.6% bracket and effectively be in a much lower tax bracket than that. It just depends on how much income you're earning over those different thresholds.
Sure.
And if we take a look at the average individual, well, the average individual is in a a 10 or 15% tax bracket. So if your mortgage rate is 4% per year, what's your effective rate of interest? Because on that 4%, if you have that 4% interest, that's what you're able to deduct, but only against your taxable income. Someone that has a $50,000 annual income might only have an effective tax rate of maybe 10%. So that means that they're getting to write off 40 basis points, roughly, or 0.4% of that 4% a year. So you're still paying 3.6% on an annual basis, and that is a real cost. Regardless of the deductibility of that mortgage, you still have that real cost. You know, and I have to say this, I've never seen a retiree that have walked into our office and said, boy, I'm really happy I've got this big old mortgage as I step into retirement. The retirees that we work with that are at peace the most have the smallest amounts of debt. They're stepping into retirement debt-free. That's the way we want to be when we step into retirement. We're never going to recommend that you come in, you step into retirement, and you take out a large mortgage so that we can then double or triple or quadruple the value of that as we stick it in the market. Yeah. Because there's no guarantees when we take that level of risk. Mm-hmm. You know, some of these other reasons, your mortgage doesn't affect your home value. So, a mortgage won't stop you from building equity in the house. So what? We know these things are already true. That doesn't mean that it's good to carry additional debt. A mortgage is cheap money. Well, as opposed to what? Yeah, sure. So I have to pay additional expense one way or another, and I want that to be my home?
Well, we talk about that. With those interest, those mortgage payments, you're paying basically interest for the first many years of that. Now, I think you've got an example where you look at those payments and go, geez, we've been making these payments for a number of years. We really haven't seen our equity build because you're mainly paying interest.
Well, my wife told me that. She logs into our bank accounts and she can see our mortgage balance. And she said, boy, we've been making these mortgage payments for months and years. But it doesn't seem like this has really reduced our debt very much. Well, it's because it's marginal. There's a large portion of each one of those payments, especially in the early years, where it's going to pay for the interest and service the debt, service the mortgage. And that's not explained in here. Another thing that really drives me nuts, that says mortgage payments get easier over time.
Yeah, that's number 6, right?
Okay, so mortgage payments will get easier over time as long as you continue to make more money in the future and you don't have any financial hardships.
Well, to me, that's a little bit like saying, hey, you're going to be in prison for the next 10 years, but you know what, those it's going to get easier over time, right?
Right. Yeah, and he finalizes this article, reason number 11, you'll never get rid of your monthly payment no matter how hard you try. Now, I think we know that that's not true. You may still have to pay for your taxes, you still have to pay for your basic home maintenance costs, but you don't have that payment, and not having that payment could be thousands and tens of thousands, hundreds of thousands of dollars in your pocket over your lifetime. Retire with peace. You want to sit down and retire and focus on return on life, not just return on investment. Your goals have shifted from accumulation at all costs to preservation and distribution. It's time to make life simpler, and we want to give you that opportunity today. If you have found any of these topics interesting and you want to learn more about these topics we're discussing on the purpose-based retirement and ensure you're 100% prepared for your retirement future, then visit our website today. That's thepurposebasedretirement.com, where you can pick up a free copy of my latest book, The Purpose-Based Retirement, or you can get a copy of my 2017 guide to maximizing retirement efficiency to uncover action steps you could take this year to make 2017 your best year ever. Again, that's thepurposebasedretirement.com. And as always, feel free to give us a call if you have any questions or concerns. Give us a call. Our certified financial planners can be there standing by to answer any specific questions or concerns you may have at the number on your screen. We'll be right back after this short break to take questions from you, questions about HSAs, bonds, annuities. We'll be right back. Just stick around.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college.
How will I remember you?
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshal Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Welcome back to the Purpose-Based Retirement. This is your host, Casey Weade. Joining me, my good friend and co-host, Marshal Johnson. A couple certified financial planner practitioners here to take questions from folks just like you. So we're going to kick off our questions here today. And I think we've got Chuck from Fort Wayne on the line.
Yeah, this is Chuck from Fort Wayne, and I'm turning 65 later this year, and I want to retire on my birthday. What I want to know is, can I still contribute to my HSA during retirement?
Chuck, thank you for the question. Fantastic question. And I'm glad you've found the wonders of the HSA. That's a health savings account.
Sure.
Fantastic account for individuals that are still working. You know, we often say, let's go ahead and put your contribution to your 401k, get your match, and then if you have a high deductible health plan, then you're able to contribute to an HSA, then you do that after you make your Roth contributions. And the great thing about a health savings account is that you get to tax-free contributions, and then they grow tax-free until you need them in the future, as long as you use them for health expenses, healthcare expenses. And the beauty of a health savings account is that even if you don't use it for health expenses in the future, it just ends up operating a lot like a traditional IRA. The contributions were tax deductible, and as long as you're over 59 and a half, you don't have those penalties to use them for things other than healthcare expenses. Now, the issue being, unfortunately, once you hit Medicare age, once you get into retirement, either you don't have the income that you can deduct because it has to be working income, or now you've gotten into 65 and now you're on Medicare and you can't contribute to a health savings account.
Yeah, I think that's a great answer, Casey. And HSA, there is wonderful power in those accounts, especially.
Oh, yeah. I've got one, and you've got one.
Well, and especially for folks that are talking about retiring a little bit early. If you're going to be retiring at 60 or 62 and maybe being on your own for healthcare expenses, then start funding that HSA now. Start to build up that reserve, because you may want to have a higher deductible when you're paying those premiums all yourself.
Sure. Yeah, and I think it just makes a lot of sense. If you don't have an HSA or you can't spell HSA, then it's time to sit down with someone that can help you figure out how you can save more money on taxes. We go through the statistic all the time on the show. When it comes to taxes, there are, I believe the study was done by Vanguard in 2009, and it showed that 74% of individuals are concerned about taxes, while only 30% of them are actually implementing tax advantage strategies. Yeah. So if you're in that 70% that's not implementing some type of tax strategy for your retirement, especially if you're 5 or 10 years out from retirement, that's the best time to get on it and start getting a tax plan put together. And it may even include an HSA. Thanks for your question, Chuck.
Next up, we've got Jerry in Angola.
I'm concerned with the current inflated stock market and want to protect my next few years of income needs in case of a crash. However, I don't want to just leave it in cash. I hate annuities and I'm concerned about bonds. Where do I turn?
Well, Jerry, I appreciate your question. That is a great question. And you know what? I like the sentiment that you're at least thinking about the money that you're going to be needing for income, because when it comes to retirement, income is the priority, Casey, not growth. She's got some opinions here about annuities and bonds.
Kind of sounds like Ken Fisher. I hate annuities.
Yeah,
you should too.
And it's okay to have a bias, but the thing you got to realize, Jerry, is that we all carry these biases around, and you're going to have confirmation bias. If you want to listen to those folks that talk about how terrible annuities are, then you're just going to reconfirm those beliefs. But I tell you, in this low interest rate environment, you need to at least be open and get an education about the modern tools that are out there. Yeah. Annuities today are much different than they were 5, 10, 15 years ago.
Yeah, and it's not to say that we love annuities. I mean, we hate annuities as much as the next person and hate stocks as much as the next person. It just depends on the individual stock that we pick or the individual annuity that we pick. You know, out of the hundreds of different stocks or hundreds of different annuities out there, there's very few of those that we're actually going to like. There's a lot of bad out there in the world, and it's typically just comes out of the purpose that we're actually going to use those dollars for. I had a gentleman that came in and he said the same exact thing. We're sitting in our conference room and we're talking about his income strategy. He said, Casey, I want to make sure that I protect my first 5 or 10 years of income so I don't have to worry about what we talk about all the time, which is sequence of investment returns risk. And so we wanted to have some protection. So how do we do that? Well, we can do it with fixed income with things like bonds, or we can do annuities. He said he hated annuities, so we ended up going the bond route. We built a bond ladder that showed him that a bond would come due every year, satisfying that income stream that he needed, and he wanted to stay in investment investment grade corporate bonds. In that investment grade corporate bond, building a 10-year bond ladder, the rates that we're getting today aren't a far cry from what we can get with an insurance company with a fixed annuity or fixed indexed annuity. They're in that 3 to 4% range for a bond ladder that's going to be over 10 years, maybe 5%, a little bit more in those long-term bonds, 2% or less on the short-term bonds. And if we can get greater degrees of safety with an insurance company, then it makes sense. But it's all about knowing the facts and having someone present you with those two options, and you make that decision for yourself, because being the way we're compensated and the way that we're licensed, we are indifferent. So thanks for your question, Jerry. Our next question from Jenny in Middlebury.
I have 3 different financial advisors with about a dozen different accounts. It's difficult for me to follow, and I don't feel I really have a plan. How do I consolidate without losing the benefits of diversification?
Well, I appreciate the question, Jenny, and you talk about diversification. I think that's a great topic for you to stay on, but just because you have 3 different financial advisors doesn't mean that you're inherently properly diversified. They could be doing very similar things, and what you really need to do is kind of take a step back and get a second opinion from all the advisors that you currently have. It can be very difficult. If you can have more than one cook in the kitchen, but if you get too many hands in there, Casey, we could start to get a lot of overlap, and we see this when we have families come into the office and we stress test their holdings. And really, you need to get a stress test, Jenny, and have somebody give you an objective third-party opinion of where you're at, where it's going, and you need a plan. I heard you say plan. It doesn't sound like you have a plan. You just got 3 different guys doing maybe the same thing.
And I've seen this before. I had a gentleman that said, I really hated my broker, so I moved my money. And he had it in C-share American funds in his simple IRA, and then he rolled it over to a broker who bought A-share American funds inside of another IRA.
Almost the same thing,
IRA.
right?
It was the same thing. It just cost him more up front, and maybe he found somebody that he liked better. But just because you're working with multiple people doesn't mean you're getting true diversification, especially if you're only working with someone that works with only investments, stocks, bonds, and mutual funds. Then you're not getting true diversification, which should be diversification based on your purpose. Now, if you have questions like Chuck, like Jerry, like Jenny, then we hope you take advantage of visiting our website today and learning more about what we're discussing here and ensuring you're 100% prepared for your retirement future. Visit the website at thepurposebasedretirement.com, where you can pick up a free copy of my latest book, The Purpose-Based Retirement, or get your copy of my 2017 guide to maximizing retirement efficiency to uncover action steps you can take this year to make 2017 your best year ever. Again, that's thepurposebasedretirement.com. And if you have any specific questions or concerns you would like to get addressed, give the team a call at the number on your screen. Now it's time for our question of the day. So our question of the day is this: testing your financial knowledge. Historically speaking, which quintile of market valuation do we find ourselves in today? Are we in the first, second, third, or fourth, the least expensive, second least expensive, or the most expensive market quintile in history? We'll be right back after the short break and an answer to your question of the day. Hi, I'm a certified financial planner practitioner. Are you one of the lucky few that will still carry a pension into retirement? Is your company offering you a buyout or a lump sum pension option? If you're seeking independent, unbiased advice from an advisor that can inform you about all of your options, then look no further. You deserve a lifetime of financial confidence due to a lifetime of income. And at Howard Bailey Financial, it's our goal to help you achieve that. If you'd like to see how a CFP professional can best serve you, give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshal Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Welcome back to the Purpose-Based Retirement. This is your host, Casey Weade. I'm joined by Marshal Johnson here today, and we've covered a lot of topics with you. We talked about mortgages, we've discussed HSAs, we've talked about Roth IRAs, annuities, and bonds and stocks. We cover all these topics, and it comes down to protecting your life savings. So answering the question of the day, historically speaking, which quintile of market valuation do we find ourselves in today? Are we in the least expensive, second least expensive, second most expensive, or the most expensive market market in history? The answer is unfortunately D. For those of you that are just stepping into retirement or just 5-10 years out from retirement, being in one of the most expensive markets in history presents its challenges, and the biggest of those is equity returns moving forward. What we want to discuss is this irrational exuberance. Being in one of the most expensive markets in history, people are still very confident in future market returns, and we see the market continuing to rise. We call this irrational exuberance. That was originally coined by a gentleman, Alan Greenspan, our Federal Reserve president, back in the 90s, discussing the dot-com bubble. And that advice was largely ignored, and it shouldn't have been. Today, irrational exuberance is largely used by Harvard economics professor at Yale. That would be Robert Shiller, to discuss the market that we're now seeing, the bubble in valuations or price to earnings ratios. If we look forward, we can say that if we look at GMO and Husband funds, they put together based on the historical starting valuation from the S&P 500 from 1940 through today, and they can show us what the potential downside is. Over that period of time, in the cheapest markets, these would be the markets like the early 80s, right before we saw the boom through the 80s and 90s and 1,000% return in just 17 years. During a cheapest quintile market, that means a very inexpensive market, the worst drawdown was 22%, and the average 3-year drawdown when there was a bear market was just 4.5%. Now, in the most expensive markets, like we're finding ourselves in today, the worst drawdown was 50%, with an average drawdown of 18% over 3 years. This is where you have to ask yourself, how would I do over the next 3 years in a negative market? I had a gentleman that was him and his wife, they're from Maryland, they're going to retire in 5 years, and over the next 3 years, he said, I feel like I can continue to take this risk that I'm currently taking. But if we stress test that portfolio and he gets no returns on his overall portfolio for the next 5 years, he's out of money during his first 15 years during retirement versus only making 3 or 4%. He's perfectly fine. Sometimes it pays to focus on protection, especially when the market's expensive. If we look at market valuations and track them against this red line, which is the S&P 500, this black line here is 10-year PE ratios or valuations for the market. How expensive is the market? We find during, say, the 80s and after the Great Depression, the market was very inexpensive, and as a result, it saw very strong gains into the future. We're seeing the end of 2014 here, and we can already see that we are entering that high valuation band on the S&P 500 at about 18.85. Today, that number is closer to 30 than it is 20, and that's why we say the markets are expensive. Let's exercise caution. It's not just that the markets are expensive, it's that we're also seeing people take on debt in order to buy into the markets under what's called margin debt and net credit balances. If we look at what happened during the dot-com bubble, the crash of 1987, these gray areas show us peaks in the amount of debt that was being taken on to buy into the stock market, the credit bubble of 2007, and now we see the largest credit balances that we've seen in years, and that is resulting in what we would say is an even greater inflated market. Now, if we take a look at the valuation confidence composite, that's going to take a look at how confident people are that the markets are going to be higher in the future than they are today. That is reaching an all-time high, and that is the definition of irrational exuberance. CNBC puts together a fear and greed indicator, indicating how much greed is currently being seen in the markets, and we see today that that meter is pushed all the way to the right, which is extreme greed. Right, Marshall?
Yeah, extreme greed. We're seeing it. We see it in the office week in and week out, where we're starting to see people come in and they look at their returns and go, geez, I want to make more. The market's up, or my neighbor did this, or my cousin is up this much year to date. So tell me, what can we do in this environment, Casey? Well, one thing you can do is just be aware of it. And I think that's part of the reason why we're talking it. And you talk about the credit balance, and that chart is amazing because you see how much, we just talked in the first segment about taking out a mortgage. to buy into the market, and that's what
exactly. And there's things that you can do to manage that risk. You don't just have to accept the risk. You can manage that risk. You can transfer that risk. You can reduce that risk, but at least have a plan. Also taking a look at corporate debt. We often talk about debt, credit card debt, student loan debt. You often hear about the federal debt. However, you're hearing about large cash balances with corporations, but they're also some of the most levered that they've ever been throughout history. Corporations are also taking on incredible amounts of debt, and that is leading to, again, more of a bubble. If we look at 7-year asset class returns looking forward based on our current valuations, this might be the most startling thing. U.S. equities, based on current valuations, are looking at a negative return over the next 7 years on average, negative 3.4%. U.S. equities, small caps at negative 2.7%. One of the bright spots of the market are actually emerging markets and some of those international markets that have some of the best potential because they've been beat up as much as they have. Again, when you go shopping, you want to buy things that are on sale, not things that are overpriced, and that's what you might find in U.S. markets. If we look at those valuations, again, a PE ratio or price to earnings ratio, in different periods of time, we can see in 1989, the PE ratio is 13.9, and it resulted in a 15% annualized rate of return for the following 10 years. If we look at 2000 to 2001, PE ratios hovering around 20 and 23, we saw negative and flat returns for the following 10 years. And now we find ourselves today not at 20, not at 24, but almost 30 on a PE ratio. What does that mean for equity returns moving into the future? What we want to protect you against is being just like Sir Isaac Newton, one of the UK's most famous president, the most famous scientist of all time. If we look at what he did, we can learn a good lesson. There was a company called South Sea, and South Sea took over and took over the debt of England when they had their war debt. They took over the war debt in trade for a monopoly over trade in the South Sea. And during that period of time, Newton, along with some of his friends, said, hey, this is a great idea. Let's buy some of this South Sea stock. And when he bought it, he was able to double his money in the early 1700s in just a couple of months. He went from investing a little bit to exiting very happily after doubling his life savings. And then a few months later, he sees his friends get rich. Now, Isaac Newton, now he's getting a little frustrated and a little jealous of his friends and his family, and he ends up buying back in at the top, and he ends up losing nearly his entire life savings, about 20,000 pounds, which would today be worth over $5 million. This is what we don't want you to do, is to buy back in now. Don't get greedy. It's time to put together a plan to ensure that you're going to be okay regardless of what the market does in the future. If you want to learn more about the topics that we've discussed here today, we want to give you an opportunity to go out, step into our website, thepurposebasedretirement.com, and ensure you're 100% prepared for retirement. We're going to give you a copy of my latest book, The Purpose-Based Retirement. We're also going to give you an opportunity to pick up a copy of my 2017 guide to maximizing retirement efficiency in order to uncover any action steps that you can take this year to make 2017 your best year ever. Again, that is thepurposebasedretirement.com. And as always, feel free to give us a call at Howard Bailey Financial. You can talk to myself, you can talk to Marshall, one of our certified financial planners, and get any answers to your specific questions or concerns. Just give us a call on the screen. Again, that's thepurposebasedretirement.com, and we look forward to seeing you next week on The Purpose-Based Retirement.
Thank you.